Before I show you my early retirement portfolio, I want to quickly show you the video I made back in 2022. You can always watch the video on my channel if you want to, but this was when I felt that we might have hit the bottom of the market. I wasn't exactly right. That was back in September 2022, but it actually continued to drop going into October 2022. So I was off by about a month. And I just want to play you this clip right here when I talk about the stocks and ETFs I bought at the time, because the decision I made back in September and October 2022 allowed me to grow my portfolio massively in 2023 when everyone else thought it was a bad time to buy.
It's showtime.
VOO below $370 is trading at a discount, in my personal opinion. I also own a Dropbox, and I've been using their service since 2012. This is a small cap stock, and my cost basis is around $18. So I'm not looking to buy this until the price drops below $20. And I want to buy Tesla. I really do. But I'm a little worried about the Q3 earnings in China. So I want to wait and see the Q3 earnings to decide if I'm going to add more shares to Tesla. If the stock drops to $200, then this is a buy for me. Meta is a stock that I've been buying heavily recently just because of its valuation. If it continues to trade below $150, I'm going to continue to buy. DocuSign is another stock that I own, and it's trading at a 3-year low right now at about $11 billion market cap. And I'm looking to buy more DocuSign if the price continues to drop below $50. And Google, and I love this stock, Google is another stock I own, and I will continue to buy this stock if it stays between $100 and $105. And if it drops below $100, then I'm going to start buying heavily into it. And if it gets below $100, in my opinion, the S&P 500 is going to be dropping to like 3,500 points at that point. Amazon is a stock that I haven't been able to buy because of its valuation. If it drops below $110, then I would consider buying. But I'll probably wait until the Q3 earnings report. And Apple is another stock I'm keeping an eye on, and I don't own any Apple right now. If its market cap drops below $2 trillion, then I would consider owning Apple. And Netflix is another stock that I'm keeping an eye on too, because the valuation has finally come down to about 22 or 23 forward PE. And this is the cheapest valuation I've seen in so many years. So if this stock drops to about $200 or below, then I would consider buying it. My goal right now is to buy as much as I can while the stocks are trading at a Black Friday discount.
Let me show you how my stocks have performed in the past year. And at the time I'm recording this video, I'm exactly halfway from when I started my financial independence journey in 2016 at the age of 30 until I reached my FIRE number at the age of 45, so that I have the option to retire early if I want to. Since I can't touch my 401k, Roth IRA, or HSA until way later, my primary investment vehicles are my taxable brokerage accounts, business, and real estate. And now real estate is going to be a tricky one because I'm still not sure how much of my portfolio should be in real estate. The only variable in real estate is the tenants. And if people tell you real estate is a passive income source, they're lying to you. It is a lot of work. If I decide to retire early because I have enough money in my taxable brokerage accounts, then I can start what's called a 5-year Roth IRA conversion rule process. Now I'm going to make a very detailed video about this in the future, so be sure to subscribe if you haven't done that already. My main strategy is to live on my dividend income, real estate income, Roth conversions, capital gains, and possibly the securities-based lines of credit with my taxable brokerage account. And I will also talk more in depth about this in the next video that will come out in about a few weeks. The first one I'm going to go over is my growth account, and I focus primarily on growth in this account. And I have another account that focuses on dividends, but I'll go over that later on. So right now I have Meta, Dropbox, Tesla, FDRXX, and the S&P 500 index fund. And I actually ended up selling DocuSign because I didn't like their earnings report that came out in Q1. I never got to buy Netflix or Amazon, but I bought plenty of Google in my Roth account. The biggest weight of this portfolio is actually Meta at 32% because it has grown so much over the years. As I said in that video, I took advantage of how cheap the stock price was in 2022 when the share price dropped below $100. This stock alone has made over 73% in return in 2023 in my portfolio. Some people might have made 100%, some people might have made 200%, right? But I've owned Meta since 2017, 2018, okay? But this is actually not the biggest winner of my portfolio. The Dropbox stock made a really great return in 2023 with over 31% in return so far. And I've been using Dropbox for over 10 years before the company even went public. They are an excellent cloud service that I use for my clients and video editing. And I really like their business model too. So I don't plan to sell this out anytime soon. And I remember when the share price was only below $18 at one point, my Tesla stock actually performed the best with over 104% return just in 2023. And I actually first purchased Tesla back in 2018, which was the same year I bought my Tesla Model 3 that's still in my garage right now. And the 104% return was just in 2023. You can look up how much the Tesla stock performed since 2018. And the next one is FDRXX, which is the Fidelity Government Cash Reserve that pays about a 5% APY. But after all of the management expenses, the net return was actually about 4.79%. And I have about 15% of this portfolio in this mutual fund just to keep the cash growing for 2023. And the next one is the S&P 500 index fund. It's also performed really well with a 24% return. So the total portfolio return for 2023 is 47%. This is just absolutely incredible because it's put me way ahead of my projection to achieve my FIRE number in 8 years. And this is how I plan to allocate my growth stock portfolio going into 2024. And I'm not looking to sell any stocks because that would be silly with all of the capital gains tax, right? But I would like to de-risk the portfolio just a little bit and buy additional ETFs going into 2024. 71% of this portfolio right now is in individual stocks. And it's not what I intended, but Meta, Dropbox, and Tesla just all blew up in 2023. And it blew up back in 2021 as well. And I'm most likely going to buy more S&P 500 index fund and QQQ in the first quarter of 2024 so that the index fund portion of this portfolio is increased to at least 35%. And we'll see what happens with the market at that point. I need to pay attention to the company earnings when they come out in Q1 of 2024. And if you're interested in joining my private client program to get financial coaching and financial planning services, you can schedule a free consultation with me by visiting firesightchair.com/coaching. And I also recently launched a brand new website where you can sign up for a free membership to get your free financial resources by visiting firesightchair.com/resources. The next one is my dividend stock portfolio. And this is by far the biggest loser of my portfolio. You could argue that I made bad investment decisions. And to a certain extent, I would agree with you. The 26% of my dividend portfolio is in Walgreens Boots Alliance. And I've been holding this stock for a long time. And they faced a lot of headwinds in 2023, but I've had this stock since about 2017, 2018. The only thing that's compensating for the 29.5% loss is the 7% annual dividend yield. And I'm not going to sell the stock because I already did tax loss harvesting with other stocks that I already sold back in 2022. And my Verizon stock is really massive in my portfolio. And it makes up about 40% of my portfolio at the moment. Verizon took a huge loss in 2022 when the stock was actually down over 30% in the year. And it's actually making a comeback right now. And it's now down about 6.5% year to date. I haven't bought any Verizon because the position was way too massive. And this is another stock that pays 7% in annual dividend yield based on its current stock price. And Target is a stock I started purchasing at the end of 2022. And I bought a lot more at the beginning of 2023. And it's paid off quite nicely, but I still haven't recovered from last year's losses just yet. And the stock is down about 7% at the time I'm recording this video. But I am looking to add just a little bit more to this position depending on the company's earnings in Q1 2024. The next one I own is SCHD, or Schwab's High Dividend Yield ETF. This is the only one that's winning so far in 2023 with a 5.6% return. This ETF tracks all the stocks that pay high dividends, so it's less risky than the other individual stocks I own. Obviously, these are all very risky and they're not paying off very well, right? So this dividend portfolio lost a total of 9.5% in 2023. Could I have done better? Absolutely. The Walgreens stock hit me probably the hardest early in the year. And I really didn't see that coming because it was down over 40% at one point. But this is the risk I am having to deal with for having the majority of my portfolio in individual stocks. So in 2024, I plan to have more money allocated to SCHD at 70%. And that will make 70% of my dividend portfolio, which will pay over 3% in annual dividend yield. Target, Verizon, and Walgreens should only make up less than 30% of my portfolio. And my plan is to sell some Verizon as soon as the stock turns green and reallocate it to SCHD. I have to make sure that I don't sell them at any losses because I already have carryover losses from the previous year in 2022. Now, despite the 9% loss in my dividend portfolio, I am still on track to achieve my FIRE number at $3.7 million in 8 years. And here's the reason why. 75% of the contribution goes to the growth stock portfolio and 25% goes to the dividend stock portfolio. I have to keep in mind that I have to pay at least 15% in qualified dividend tax every year. It doesn't matter if I reinvest the dividends or not, I have to pay those taxes. The growth stocks are much more tax efficient because most of them don't pay any dividends. They're just growing in capital appreciation. This is what I know for sure. I'm going to have at least $50,000 a year in dividend income in 8 years with $1.25 million invested. I'm going to have a business income, but I don't know what that amount is just yet. If I'm still running the business then I would imagine I would make at least $100,000 a year as a corporation. And I'm also gonna have $44,000 a year in Roth IRA conversions from the pre-tax retirement accounts, which I'll talk about in next week's video. Now, either sell the stock for $20,000 a year to take out a line or take out a line of credit so I don't pay 15% in capital gains tax or more. But all that in total should be around $144,000 a year. And I encourage you to write your own timeline. When do you want to retire? And how much of your retirement income will replace your current income? Will it be 60%, 70%, 80%, or 100%? I started my financial independence journey to focus on one thing, and it's not to retire early, but to achieve that FIRE number. When I achieve that $3.7 million FIRE number, I don't necessarily have to retire early if I love my job. And I also don't need to hit $3.7 million if I have multiple sources of income. And I want you to have a job because you want to do it and not because you have to do it. Let me know in the comment section down below where you are on your FIRE journey.